Hi, and welcome back to the Food Fund. In this video we will be analyzing if Sprouts Farmers Market stock is a buy. Sprouts, stock ticker symbol SFM, is just one of many companies we explore on this channel. The Food Fund is focused on all things related to investing in food, beverage, and restaurant stocks. If you are new here, our goal is to help you put your money where your mouth is and invest in great companies. If you love food and love stocks, you will definitely love this channel. We have a lot of goodness to cover, so let's go ahead and jump right in. Cue the logo. Let's start with some background info on Sprouts Farmers Market. Sprouts was founded in 2002 in Arizona as a family-owned local grocer. In 2011, Sprouts combined with other grocers in an effort led by private equity giant Apollo Global Management. 2 years later, the revamped regional grocery chain became a publicly traded company. Today, Sprouts has around 35,000 employees and operates more than 380 stores in 23 states. Now let's look at the price action. Starting with the 1-year chart, we see that Sprouts had a CAGR of about 61%. Zooming out to the 5-year chart, we see that Sprouts had a CAGR of 9%. Sprouts' share price has risen dramatically this year. If we perform a backtest comparison of investing $10,000 in Sprouts versus the S&P 500, we find some interesting results. In that comparison with the S&P 500, $10,000 invested in Sprouts would have generated $17,577 or a 10.3% CAGR versus $17,654 or a 10.4% CAGR if invested in the S&P 500. Though the returns are very similar, the two investments have very different characteristics. A Sprouts investment would have been much more volatile with a 33% standard deviation, a measure of volatility, despite both the best year and worst year performance beating the S&P 500. Sprouts' max drawdown of 44% is nearly twice that of the S&P 500. Accordingly, Sprouts underperforms the S&P 500 in comparisons using the Sharpe ratio and the Sortino ratio. Let's take a look at the fundamentals to find out more. Gross margin is 37%. This is pretty strong for a grocer. Revenue has compounded at around 6% over the past 5 years and has reached nearly $6.6 billion most recently. Steady revenue growth and good gross margins make this grocery store pretty interesting. Looking at cash flow, we see a 10% CAGR over the last 5 years for operating cash flow, while capex has diminished slightly at a CAGR of -1%. As a result, free cash flow has increased at a 22% CAGR. While it is a bit bumpy, the trend is clearly improving over time for Sprouts. Weighted average shares outstanding have decreased over the last 5 years at around a -4% CAGR, going from 130 million shares in 2018 to 106 million shares most recently. Sprouts has been slowly buying back shares. This is a very effective use of cash flow. Now let's view return on invested capital. Return on invested capital has fallen from 13.7% in 2018 to 11.2% in 2023. Though there was an initial drop, the return on invested capital has steadily been climbing since 2019. This is a big positive. Another favorite metric is cash conversion cycle, a measure of operational efficiency regarding supplier and payer leverage as well as inventory control. Going from 15 days in 2018 to 13 days most recently, Sprouts has maintained decent efficiency, although I would like to see this value flip negative. It is currently in a manageable position. Last, let's explore Sprouts' debt. The net debt to EBITDA has been flat over the past 5 years and is currently 1.7. Again, not much to complain about here. Management has done a pretty good job of running the company. The fundamentals of Sprouts are not bad and it may still be a buy for some investors. In any event, should it be added to the portfolio? Before sharing my final thoughts on that, please click the like button and let YouTube know that you like the content. Subscribe and click the notification bell to make sure you catch the latest videos. Your continued support means so much to the Food Fund. Now, let's get into my final thoughts. Okay, let's go to the spreadsheet and write out some key values for Sprouts. It is a grocer with a gross margin of 37%. The 5-year revenue per share CAGR is 10% and the 5-year free cash flow per share CAGR is 28%. Good margins, great growth. This is looking tasty already. A return on invested capital of 11% is okay, but the value has been rising over time. Next, the cash conversion cycle of 13 days is okay, but this may be one area for the company to focus on improving going forward. Concerning debt, a net debt to EBITDA of 1.7 means that it takes Sprouts a little under 2 years of earnings to pay off their debt. So from a fundamental standpoint, Sprouts looks really strong. Now let's switch our attention over to valuation. Sprouts is undervalued relative to the S&P 500 with a ratio of 0.7. The price to earnings growth, or PEG ratio, is 2.3, which means that Sprouts is a bit overvalued compared to its projected earnings growth. But that growth has been amazing, so maybe we should be willing to pay a premium? Sprouts' share price appreciation this year is warranted by its great underlying fundamentals. Starting with a good gross margin and strong growth, Sprouts is very solid. What is interesting to me is that Sprouts seems to be very similar to Whole Foods and Erewhon, focusing on natural and organic foods at a premium price point. It is unclear to me what sets these three grocers apart from one another, but there seems to be space in the marketplace for all three. Regardless, Sprouts has sprouted my interest and is going on the watch list. Many thanks for watching. What do you think about Sprouts and its tremendous growth? Please share your thoughts below. It is always great to hear from you. Please check out some more videos right now and don't forget to put your money where your mouth is.